Forex trading has exploded in popularity, with more than $6 trillion being traded in the currency markets each day. Unfortunately, with this popularity comes many myths and misconceptions that can mislead new and even intermediate traders. Believing these myths can negatively impact your trading decisions and expectations. In this comprehensive video, we'll debunk the top 5 Forex trading myths that many beginners, and even some seasoned traders, still believe. By separating fact from fiction, you can approach the Forex market with a clearer, more informed mindset and improve your chances of long-term success. Let's dive in. Many people are drawn to Forex trading by promises of easy money and quick success. But the reality is far different. It's crucial to debunk common misconceptions so traders can focus on what truly works. Myth description: Forex is a quick and easy way to get rich. This myth lures countless beginners into trading. You've probably seen flashy ads or social media posts of traders flaunting luxury cars and stacks of cash, all implying that Forex trading is a quick path to wealth. The belief is that with a small investment and minimal effort, you can double your money overnight. Reality: the truth is that Forex trading is far from easy money. Successful trading requires knowledge, skill, and experience, just like any other profession. While it's possible to earn profits, it's equally possible to incur significant losses, especially if you dive in with unrealistic expectations. In fact, statistics show that a majority of new Forex traders lose money in the beginning. According to regulatory data, about 2/3 of retail Forex traders end up losing money over time. This isn't to discourage you, but to highlight that Forex is not a guaranteed shortcut to riches. Successful traders spend years honing their skills, developing effective strategies, and learning risk management. It takes dedication, practice, and continuous learning to become consistently profitable. As one source notes, Forex trading requires a realistic mindset and long-term goals. If it were truly a get-rich-quick scheme, everyone would be doing it and becoming millionaires overnight. The reality is that even famous Forex success stories, like George Soros's one-day billion-dollar profit, are extremely rare and come with immense risk and experience. For everyday traders, consistent success comes from treating trading as a skill-based endeavor, not a lottery. Debunking the myth: don't fall for the hype of instant wealth. Forex trading is not a lottery ticket. It's a skill that takes time to develop. You need to study the market, understand how economic events affect currency prices, and practice trading strategies. Many top traders recommend starting with a demo account and educational resources rather than live trading right away. This allows you to practice in a risk-free environment and learn from mistakes without losing real money. Remember, like any field, be it medicine, engineering, or sports, expertise in trading comes with time and effort, not overnight. Takeaway: approach Forex with a commitment to learning and realism. Set achievable goals and focus on building your trading skills step by step. With patience and discipline, you can work towards profitability, but there are no shortcuts. In summary, Forex trading is not easy money. It's a challenging endeavor that can reward those who put in the work, but punish those looking for quick wins. Myth description: only the rich or big institutions can trade Forex. You must have a huge capital to even begin. This myth dates back to the days before online trading, when the Forex market was primarily accessible only to banks and wealthy investors. Many new traders still believe that you need tens of thousands of dollars or more to trade effectively, or that Forex is only for Wall Street professionals. Reality: you do not need a fortune to start trading Forex. In today's world, Forex trading has been made accessible to almost anyone. Thanks to online brokers and leverage, you can control relatively large positions with a small amount of capital. Many reputable brokers offer accounts with low minimum deposits. Sometimes you can start with as little as $50 or $100. This means beginners can dip their toes into Forex without a massive upfront investment. It's true that before the 2000s, an individual typically needed a high net worth and at least $1 million to access the interbank Forex market, but now technology and competition among brokers have lowered the barriers to entry. All you need is a computer, or even just a smartphone, an internet connection, and a small amount of risk capital to get started. Leverage provided by brokers allows your $100 or $500 to control a larger amount in the market. For example, with 100 leverage, $100 can control a $10,000 position. This is a double-edged sword, however. While leverage lets you start small, it also amplifies both your potential profits and losses. So risk management becomes even more crucial when trading with a small account. Debunking the myth. The notion that you must be wealthy to trade Forex is outdated. Forex is no longer an exclusive club for large investors. Regular people can and do start trading with modest funds. For instance, many beginners start with a few $100s just to learn the ropes. In fact, starting small can be wise. It allows you to practice and make mistakes with manageable stakes. Over time, as you gain experience and confidence, you can consider adding more capital. That said, keep in mind that having more capital does provide some advantages. A larger account can withstand more volatility and gives you flexibility to diversify your trades. But it's not a requirement to learn or to begin making profits. Plenty of skilled traders have grown small accounts gradually through disciplined trading. The key is to trade only with money you can afford to lose. Never risk money that would put your financial well-being in jeopardy. Takeaway: you don't need to be rich to trade Forex. Start with an amount that you're comfortable with and focus on learning and consistency. As one source advises, start with what you can afford and focus on growing your account over time through disciplined trading. By busting this myth, you'll realize that the door to Forex is open to virtually anyone. It's your strategy and mindset, not the size of your wallet, that will determine your success. Myth description: Forex is basically gambling. It's all luck, and you're betting your money with unpredictable outcomes. This myth arises because both trading and gambling involve risk and money on the line. A newbie who sees rapid price fluctuations might think the outcome is pure chance, similar to spinning a roulette wheel. Detractors of trading may even say, you're just as likely to lose money trading currencies as you are at a casino. Reality: while it's true that Forex trading involves risk and uncertainty, equating it to pure gambling is misleading. Forex trading is not just blind luck, it is based on analysis, strategy, and probability. In gambling, like slots or roulette, the odds are inherently stacked against you, and there's nothing you can do to influence the outcome. It's purely chance. In contrast, successful Forex traders use skill and research to tilt the odds in their favor. They perform technical analysis, studying price charts and indicators, and fundamental analysis, examining economic news and trends, to make informed decisions. They also manage risk carefully by setting stop-loss orders and sizing positions prudently, which gamblers typically cannot do in a casino setting. Think of it this way: a professional trader treats trading like a business, whereas a gambler is just playing a game of chance. A trader has a trading plan, uses risk management, and looks for setups where the probability of winning is higher than losing. For example, a trader might determine that on a particular trade, they have a 60% chance of success based on analysis, not a guarantee, but an edge. A gambler at a roulette table, on the other hand, faces fixed odds, like 47% chance on red, black, and roulette, that they cannot improve no matter what they do. Moreover, in Forex, you can manage your losses. If a trade goes against you, you can exit early or use a stop loss to limit damage. In gambling, once the bet is placed, the outcome is out of your control entirely. To further dispel this myth, consider that Forex trading can be likened more to a game of skill, much like poker or chess, rather than a pure game of chance. Yes, luck, random market movements, can cause any single trade to win or lose. But over a series of many trades, a skilled trader with a sound strategy can come out ahead, whereas a gambler will inevitably lose in the long run due to the odds. As one source put it, while both trading and gambling involve risk, trading relies on analysis, strategy, and probability, whereas gambling relies on chance. Debunking the myth. Forex trading differs from gambling through strategy and risk management. If you approach the market with no plan, taking random trades, then yes, you are essentially gambling. But if you educate yourself, develop a solid trading strategy, and manage your risks, you're engaging in a calculated risk-taking endeavor, not a coin flip. For example, traders often backtest their strategies on past data or practice on demo accounts to ensure their methods have an edge. You'll never see a gambler practice at a slot machine to develop a strategy, because there isn't one. To be clear, trading is not a sure thing. Even the best strategies will have losing trades, and there is always a risk of loss. But the difference lies in how you handle that risk. Professional traders play defense as much as offense, meaning they protect their capital through risk management, such as risking only a small percentage of their account per trade, cutting losses quickly, etc. This is the opposite of a gambling mentality where someone might double down to try to recover losses. Takeaway: don't treat Forex like a night at the casino. Treat it as a business or a profession. That means educating yourself, using analysis to make decisions, and controlling risk on each trade. As one trading myth-busting article stated, develop a solid trading plan, conduct thorough analysis, and always manage your risk. By doing so, you shift the odds in your favor over time. In the long run, disciplined and informed trading can yield consistent results, whereas gambling without an edge will not. Remember, trading isn't about certainty, it's about probability. Your goal is to have a positive edge and let that play out over many trades. Myth description: the big players always win, and the little guy can't catch a break. The market is fixed, or brokers are hunting my stops. This is a pervasive myth that often surfaces after a trader has a bad experience. For instance, you set a stop loss, and it seems like the market just touches your stop level before reversing, making you feel like someone picked your pocket. Some traders believe Forex is a scam orchestrated by banks or brokers to trap retail traders, or that you cannot win because the house always wins, like in a casino. Reality: the reality is that the Forex market is not inherently rigged against retail traders. However, this myth has a few layers to unpack. Market size and players. The Forex market is the largest financial market in the world, and its sheer size, trillions traded daily, makes it very difficult for any single entity to rig or fix prices long-term. Prices in the major currency pairs are driven by macroeconomic factors, like interest rates, economic data, geopolitical events, and overall supply and demand from millions of participants globally. Large institutions, banks, hedge funds, do account for a big portion of trading volume, but they are typically competing with each other or executing business needs, not deliberately targeting individual retail traders. In fact, most big players are too busy managing billion-dollar positions. They're not interested in your $500 trade. As one source explained, major institutions have their own mandates and don't have time for deliberate manipulation of the retail side, and the market's liquidity is too high for sustained manipulation. Broker practices. Now, it is true that not all brokers are saints. There have been unscrupulous brokers, often unregulated offshore ones, that engage in shady practices like stop-loss hunting or price manipulation on their platforms. This is likely where much of the rigged perception comes from. If you trade with an unregulated or dishonest broker, they might manipulate quotes or delay executions to their advantage. However, the solution is to choose a reputable, regulated broker. In recent years, there's been increased scrutiny from regulators, and most licensed brokers operate with transparency. They make money mainly from spreads and commissions on your trades, not by trapping you. In fact, they want you to keep trading, not blow up. Always do your due diligence. Check that your broker is registered with regulators, for example, CFTC, NFA in the US, FCA in the UK, etc., and read reviews. Normal market behavior versus myth. What about those times when the market does seem to hunt your stop? Often, that's just normal market volatility. Around key price levels or news events, price swings can be abrupt. What feels like a personal attack is usually just how markets work. For instance, many traders place stop-loss orders just below a recent low or above a recent high, common knowledge in trading. During volatile periods, the price may indeed dip past that low, triggering stops, before reversing, not because the market hates you, but because lots of stops clustered there create a burst of order flow when hit, and smart traders know this and might trade into those stops. This is a market dynamic, not a rigging. It teaches the importance of strategy in placing stops and managing trades, rather than assuming an unseen hand is out to get you. Debunking the myth, Forex isn't fixed against you, but you must play by its rules. Instead of believing in conspiracy theories, focus on understanding how the market actually operates. Recognize that sudden price spikes or stop runs are part of the game, often driven by news or large orders hitting the market, not a personal vendetta. By learning about market structure and liquidity, you can even turn this to your advantage. For example, avoid placing obvious stop levels or be prepared for higher volatility around news. It's also critical to use the right broker. If you're concerned about fairness, stick to well-regulated brokers with a good reputation. A good broker wants you to succeed, so you keep trading. Additionally, many top brokers offer transparent pricing and even guaranteed stop-loss execution to build client trust. Also consider the perspective. If the entire market were truly rigged for failure, we would see no successful retail traders. Yet there are many who do make consistent profits. Those traders succeed not by beating a rigged game, but by understanding market patterns, managing risk, and often by staying out of the most volatile, unpredictable moments. Takeaway: the Forex market is not a crooked casino against you. While there are bad actors, scam brokers, or signal sellers to avoid, the market itself is neutral. It moves based on economics and investor sentiment, not to punish you personally. As one myth-busting article states, the markets cannot be fixed in the long run, and currency prices are governed by macroeconomic factors and sentiment. In summary, don't blame a rigged market for every loss. Ensure you're using a trustworthy broker, educate yourself on market behavior, and accept that losses happen. By doing so, you empower yourself to trade smarter and not fall victim to the fatalistic thinking that you can never win. Many have succeeded in Forex trading, and they did it by learning the rules of the game, not by claiming the game was unwinnable. Myth description: if I find the perfect strategy or indicator, I'll never have losing trades. Or, that guru can predict every market move exactly, I should follow them. This myth is the holy grail fallacy in trading. It's the belief that somewhere out there is a foolproof system or a magical indicator that guarantees profits on every trade. Some intermediate traders chase this by constantly switching strategies or buying expensive trading signal services, thinking they can achieve near-perfect win rates. Beginnings may believe expert traders or algorithms can predict the market with near certainty. Reality: the reality is, no one can predict the Forex market with 100% accuracy. Not consistently, not over the long run. The Forex market is influenced by countless factors: economic data releases, central bank decisions, political events, natural disasters, and sudden shifts in investor sentiment, to name a few. These factors can interact in complex, unpredictable ways. Even the most sophisticated traders and computerized algorithms face uncertainty and surprises. Markets can and will do things that defy predictions at times. There is no holy grail strategy that never fails, and searching for one is like chasing a mirage. Consider this. Even legendary traders and investors are wrong sometimes. Warren Buffett, though not a Forex trader, a very successful investor, has made bad investments and admits not every decision is right. George Soros, famed for his currency trade in the 90s, also had losses in other bets. As one Forex educational source points out, even the most successful traders have seen their fair share of bad decisions and losses. The difference is that they learn from these experiences. No trader, no matter how experienced, is right all the time. In professional trading, a strategy that wins 60% of the time is often considered very good, and some profitable traders win only 50% or even less of their trades, but they manage risk such that their winners outweigh their losers. A famous trading quote, often attributed to markets lore, goes, "If you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. This highlights that losses are an inherent part of trading. The goal is not to eliminate losses, but to manage them and ensure your strategy has a positive edge over time. Debunking the myth. Accepting that you cannot be right every time is liberating. Instead of trying to predict every zig and zag of the market, successful traders focus on probabilities and risk management. For example, you might develop a strategy that historically wins, say, 55% of the time. The key then is to make sure that when it wins bigger on average than what it loses when it's wrong. This way, over many trades, the strategy is profitable even though it's far from 100% accurate. Chasing a holy grail often leads to system hopping, jumping from one strategy to another whenever you hit a few losses in the hope of finding a perfect one. This only results in never truly mastering any approach. A better path is to pick a sound strategy, test it, refine it, and stick with it, understanding that drawdowns and losing streaks happen to everyone. Use tools like stop-loss orders to cap any single trade's loss, so no one trade can blow up your account. Diversify if possible, and keep learning and adapting. Be wary as well of anyone, or any service, that promises guaranteed returns or a nearly perfect win rate. This is a huge red flag for a scam. No legitimate trader makes money on every single trade. If someone had a 100% accurate prediction method, they certainly wouldn't need to sell it for $49.99 online or share it on YouTube. They'd quietly compound their fortune. The fact is, trading involves uncertainty, and the best traders in the world embrace that. They don't predict, they prepare. They have plans for various scenarios, and they manage their reaction to what the market does rather than trying to be fortune tellers. Takeaway: let go of the idea of perfect prediction. Forex trading is about probabilities, not certainties. Instead of asking, "How can I always be right?" the better question is, "How can I manage my trades so that even when I'm wrong, I don't lose too much, and when I'm right, I maximize my gains?" Focus on building a robust trading plan that accounts for risk management, and accept that losses are part of the game. By doing so, you'll resist the allure of the non-existent Holy Grail and concentrate on consistent, realistic strategies. As experts advise, focus on probability and use risk management to protect your capital against the unexpected. In summary, no one can predict the market with 100% accuracy, but you can still succeed by making sure your overall strategy puts the odds in your favor over time. In conclusion, Forex trading, like any venture, comes with its share of myths and misconceptions that can lead traders astray. We've debunked 5 of the most prevalent myths: that Forex is easy money, that you need huge capital to start, that it's just gambling, that the market is rigged, and that you can find a 100% accurate strategy. By understanding the realities behind these myths, you can approach trading with a clearer, more informed perspective. Remember that success in Forex trading comes from continuous learning, disciplined execution of a sound strategy, and the patience to stick with it. Every trader faces losses and challenges. What separates those who eventually achieve consistent profits is the ability to learn from mistakes, manage risks, and adapt to changing market conditions. Now that you're equipped with the truth behind these myths, you're better prepared to navigate the complex world of Forex trading with confidence and realism. Let go of the myths and embrace the facts. By doing so, you'll build a stronger foundation for your trading journey. Always keep a growth mindset. The market is always evolving, and so should your knowledge and strategies. If you found this deep dive informative, make sure to subscribe to our channel for more insights and professional trading content. Give this video a like if it helped bust some myths for you, and feel free to share your thoughts or other myths you've encountered in the comments. Don't forget to check out our other videos on trading tips and strategies. They'll further help you level up your Forex skills. Thank you for watching and happy trading. Stay disciplined, stay informed, and see you in the next video.